Hey guys, Doug the Retirement Guy here. Got another bond fund review. iShares Flexible Income Active ETF, BINC. iShares is a very strong EFT company. They're showing a dividend of 5.84, so it really fits right in line with what's going on with the bonds currently. So before we get into this review, I want to thank you for watching this channel. If you haven't already, hit the subscribe button. Also, press that like button if you like what we're doing. Love to hear from you. Let's get into today's video. BINC, iShares Flexible Income. This is an exchange rate fund that invests in high yield fixed incomes. Okay, they are pretty much doing the same thing that most bond funds are. They're trying to generate regular monthly income and also try to get appreciation in a long term of basically of the stock. This was launched in 2023 and is issued by BlackRock. So you got some strong people behind it doing the right things. Distribution rate 6.30, awesome, higher than what they're, what we reported. They have a SEC 30-day yield of 5.84, which means you got some steady cash rolling in, and you got an expense rate of only 0.52%, which is not too bad on a bond fund like this. So the holdings, this one kind of blew my mind. They have over 3,098 total holdings. Okay, some of the bigger ones that I put up here, you look at the U.S. States Treasury, you got the iShares dollar high yield corporate bonds, you got some Spain, Ireland, Brazil, just a lot of different things all the way around. So it kind of got me on the start saying, how well is this account going to be? It's well diversified, but it's foreign as well. So we started looking at it, and I said, okay, first off, adding to the holdings, non-U.S. credit was 21% of the fund. U.S. high yield credit was 15%. They have residential mortgages at 10%, commercial mortgages just under 10%. So I'm like, okay, where's the money at? 65% in the U.S., 6% in the United Kingdom. Then we go down some basic regular countries. Everything that's in the EU. This was where I really started doing my login and saying, okay, if you're going to be spending all this money in different countries, what are you buying? What good quality stuff? And we looked at 25% of their fund is AAA rated. Now, if you're not familiar with bonds are all given a letter for ratings. AAA, AA, A, and actually BBB are all rated as investment grade bonds. So they're very, very safe. They're very strong across the board. The B levels, which is BB, B, are what they call junk bonds. That starts the questionable. And when they say junk, I've always said these, look, forget it. I'm not buying junk. It's just they fell below that investment grade. So when I looked at this one, I said, well, hold it. You got over 42% in investment. You add the BBBs to it, that's 52%. So it's fairly secure. And then you come in with 33% in just the junk bonds of BB and B. And I'm like, this is fairly steady. This is a solid situation. And they're picking up the Bs strictly because of they want the higher returns. Then you look at the maturity rate, and if you look at this, they're right in line with what most bond companies will be, 3 to 5 years. 34% 3 to 5. And then if you take a look at majority, almost all of your, probably 90% of your stuff is 7 years and younger. So that way, if the market does change, they're not stuck paying what I'll call a low interest rate. They're able to adjust as the interest rates go up, down, any which way. So why BINC? Well, first off, it should always be why bonds. Bonds are smooth over time to stop the roller coaster up and downs of marketplaces. Safety, if you invest in high level rated bonds, your safety in retirement is very, very secure. The reason for that is bonds are 3-year notes to corporations, and they've done all the research in the background. Is it going to be strong enough? Most of them are U.S. government bonds that they're buying to pay for the debt. So we're dialed into, it's really in a safe mode, especially when you're in investor grade. getting a 6.3% return and a 5.84 30-day SEC yield, that tells you got regular cash flow and you're getting some decent returns from the notes that they've bought. Plus, they pay monthly. And you know on this channel, I love monthly payments. So regular cash flow, you get that every month. You can pay your bills. You can do what you need to do. Or you can reinvest it. But I think in most people in retirement, they want that regular cash flow. And this is where you put your money. The returns that we got. So this is as of March 31st. So you look at the first one they went to is year to date. So in the first 3 months of the year, they're basically up 1.57%. Now that's not bad, especially when you take a look at what happened in March, where we had the big trade-off, the drop-off. The next one will be what happens in April when we got into the tariff wars. But 1 month, negative 0.41, 3 months, 1.57, 6 months, 1.42, 1 year, 6.41, and since the inception is 15.97. So a solid foundation with these guys. They're doing exactly what you expect it to do. Small growth, but paying the dividends. Now we take the dividend chart look. Now this thing here, you're going again, it's a 2-year snapshot of what's going on. And you really see that this thing it's paying a 28-cent dividend each and every month for basically every stock. Now, why is that average higher than what it looks like right now? 23 cents is basically, I'll call it their baseline. But like every good bond fund, you will see spikes up from where they were, and that is where they're paying additional funds. They either closed out a bond and cleared everything done, or they've turned around and they've picked up a couple of good bonds out of it. 90% of the time is they've closed out a particular fund and they pay out the dividends as it grows too much. When you look at that special one in January, 60 cents, I looked deeper into that and found out, yeah, they had a bunch of them that closed out to recycle through, and they just cleared out the positives of that fund. What we always do, though, is we take a $10,000 investment into any fund and we take a look at it and say, how would it really do in the real world? So April of 2024, we were able to take $10,000, put it into the fund. Stock at that time was $51.87. We bought 192 shares. We set it, forget it. And we go down to, and the two things I always like to do is, one, we're going to stop at March. And at March, as we had that crash in March, I call March Madness, we were still up 1.1% at that point in time. Then we get into the tariff wars, and this thing drops again to where basically we're flat. We're 50 cents off of what our initial investment was. It's 0.01 percentage point. We looked at the dividend, though. We made 6.44% on the dividend. So it's definitely higher than their reported 5.84 originally. And it's right in line with their distribution rate is now at 6.39. We were able to get 6.44. So overall, we ended up basically at 6.43 total return from BINC. So when you take a look in the balance of it all, they got a very strong portfolio. They got a strong holdings. The stock has done well in bad times, and we got a decent dividend return. When we look at the next thing is the price line over time, how much roller coaster do we have going on? Well, realistically, BNIC was really a steady flow. Their average price is $52.48 over a 52-week period. Their current price right now is $51.87. So it's about 1.1% below average. And I look at it and say, well, that's probably a good time to buy because you got a 1% gain there. Plus, as interest rates go down, bonds are going to go up. So as they put new bonds into this mix, you're going to have a bigger dividend coming back, which means you're going to have a better yield, which means the price of this will probably start climbing. Now this one here, I love to do too, is the BNIC held up in March. The highest price in March was at $52.46. So it still was a little bit below its average. And the bottom was the $51.87. So that 1.1% drop and the market's dropping 10 to 16%, it just tells me that the bond fund was right to be. They have it well balanced. BlackRock knows what they're doing, and they're going to run through this and keep it there. So again, very safe. So when we go back to it and look at return on investment, BNIC in the first month was down 0.71 compared to S&P 500 down 5.27. 6 month 1.48 to 597, and then year to date basically flat 0.06, and they're down 6.91. So again, another bond fund beating the S&P 500 hands down. And again, guys, we go to is no roller coaster ride here. I love putting this on there is because the stock market is a roller coaster. It's going up, it's going down, it's spinning sideways, going every which way, spinning you around. And if you're not in for the long haul, it's hard to ride. That's what bonds are about. It's almost a set it and forget it, because once you do it right, it's just a smooth sail that you just go sail away and don't worry about it. You take your 6%, enjoy it, and go on with the rest of your life. I'm not saying put all your money into bonds, but there's a chunk of it that you need to. You're probably hearing it from your financial advisor. I know mine did. As soon as the market started to get a little trembly, oh, get into bonds, get into bonds. And here we are. So in summary, a stock return over 12 months is 0.01%. Funny, I do give this a thumbs up because when you're looking at a marketplace that's dropping 10 to 16% and you're only down 0.1%, you're still very strong. You take a look at your dividends at 6.44, right in line for a bond fund. It's actually a little bit on the high side, and that's a good one. And then when you take a look at your total return, 6.43, including your dividends, when the market and stocks were all down, we give it a big thumbs up from that. So again, is BNIC good for a retirement account? And the answer is most definitely yes. It's very safe in the Morningstar. 6.44 dividend return. It's almost, you can set your clock to it. It's a solid, nice payment. Plus you're getting it monthly. And then you're technically, I'll say it's growing over time. Losing 0.1%, I can't say is a fund that's going in the wrong direction. You just look at it, give it 20 days, give it 30 days, you'll probably find out it's growing again. So again, this is going to be a moderate buy. And what I mean by that is you're not going to go take your entire retirement account, put it into this, unless you're sitting with $2, $3, $4 million, and your cost of living is low to do that. But what I'm saying is you take a good chunk of the funds that you want to have to pay your bills every month. I wouldn't be afraid to put my money into this and keep it there. Collect the 6%, live off of that. The rest of it is my fund money, and go from there. So that's why we say moderate. Don't pour all your eggs in this basket, but keep a dividend, part of your dividends as bonds, and you'll be safe throughout these traumatic times. Guys, again, this is Doug, the Retirement Guy. If you like what you're seeing, give me that thumbs up. Best of all, if you don't want to miss any of our videos, hit that subscribe button. We're putting out videos on a regular basis as the market calls. Also, if you like what we're saying or don't like what we're saying, hit that comment button and add to it. Everything helps the channel grow, and that's what we're here for, to help you and help me down the road with our investments in retirement. So guys, I hope you're having a good night and enjoy.